Let's turn to the broader markets this morning. Nasdaq's trading at record highs. Goldman Sachs this morning putting out its U.S. equity playbook for the rest of the year, forecasting some more gains ahead. Speaking of which, joining us here at Post 9 today, David Kostin, Goldman Sachs chief U.S. equity strategist. David, it's great to see you. Welcome.
Nice to see you, Carl.
Your work lately, on Friday, you had a piece about the AI trade moving into what you called phase 3. Mm-hmm. You've had some pieces about fading tailwinds from buybacks. Mm-hmm. What does this report essentially tell us?
Well, we know that about 38% of mutual fund managers have outperformed year to date. And so that's a relatively modest level. And so we're looking at what are some strategies that portfolio managers should be employing for the next several months from now to the end of the year. And so there's sort of three observations. The first is alternative asset managers. So when we look at the financial sector, banks, et cetera, a lot of financials did, sold off a lot and then in the wake of the Liberation Day, and the alternative managers, Carl, have not really come back that much. And so we think there's a valuation opportunity. We think some of the developments in the capital markets, the kind of reopening of the IPO market would be beneficial for some of the alternative manager, some of their portfolio companies. We have the prospect of some of the 401k reforms that the Trump administration has put forward. And so those are some of the, if you will, macro developments or some of the industry-related developments that would help that sector. We look also at some of the gold mining stocks, the Goldman Sachs commodity strategist, looking for the gold is going to something in the vicinity of 4,000. So that's another lookout over the next 12 months, something like 17% gain from the current levels. So that would be a potential catalyst. You got more central bank demand for that product and some of the ETFs as well. So those are, and the third I would emphasize is the companies that are benefiting or might benefit from a cut in the Fed rates, because you look at companies with a high degree of variable rate debt. And so if the Fed cuts rates, they'll have less interest expense. That leads to positive earnings revisions, and that is the argument. So those are sort of three investment strategies when we look at ways to outperform a market that's likely to go up maybe 2% from now to the end of the year, maybe 6% in the next 12 months. So there's a generally rising market, but that's the strategy we look at.
I mean, mutual fund, 38% is not bad for them, David. Come on. I mean, They don't. When was the last time they actually outperformed as a group? Never.
Well, 2022, when the Mag 7 really got
crushed.
That was, and since many of the portfolio managers in the mutual fund industry are underweight those stocks, that actually was a benefit. But
That's
you're right. In the last several years, it has been a challenging environment.
Well, it's been challenging for a long time. That said, you raised the Mag 7. Maybe Mag 8 now. We now include Broadcom.
Okay.
Continued concern?
Maybe the Elite 8.
The Elite 8. I like that. Yeah. Continued concern at all in terms of the overall weighting of 7 or 8 stocks in the S&P at this point and the importance of them?
It has been a concern. The idea that 7 stocks, for example, are something in the vicinity of around a third of the S&P 500 market cap. So that definitely introduces a unique risk to the market. One of the big variables is around the amount of capital spending that's taking place. And yesterday at the Goldman Sachs Tech Conference in San Francisco, NVIDIA commentated about the idea of $3 trillion, with a trillion, capital spending that they anticipate over the next several years from now to 2030. So that would be a tailwind to the extent that would be maintained, all that capital spending. Now that is a source of some risk, because if it decelerates and trees don't go to the sky, so that would be a potential risk. But from a fundamental point of view, we looked at the results in the second quarter, David. They had really strong earnings. All those 7 companies up like 28%.
And they didn't change their CapEx plans at all.
And they did not. And so that would be the argument. But as a concern, it's a concern because the concentration historically that does not persist for forever. And the idea of you get a catch up, where lower multiple broadening of the market rises, or do you have a catch down? Some of those biggest stocks come down. I think the catalyst for the catch down potentially would be a deceleration in the amount of capex that you emphasize, and the broadening of the market would be more consistent with our view in terms of economic activity, more companies participating in an economic expansion that's continuing at a still below trend rate right now, but likely to go back towards trend in 2026.